Welcome everyone, and thank you for joining today's in-depth discussion on the fascinating relationship between the U.S. dollar, the Kuwaiti dinar, and the global stock markets. Over the next 10 to 12 minutes, we will explore how the strength or weakness of these two currencies can influence stock prices, investor sentiment, and broader economic trends not only in Kuwait and the United States, but across the interconnected global financial system. Let's begin by setting the stage. The U.S. dollar is the world's primary reserve currency and a cornerstone of international trade. It serves as the benchmark for commodities like oil and gold, and it underpins a massive proportion of cross-border transactions. Meanwhile, the Kuwaiti dinar holds a unique place in currency markets. It is consistently one of the highest valued currencies in the world in terms of nominal exchange rate. This is not by accident. Kuwait's economy is resource-rich, built on substantial oil exports, prudent fiscal management, and a currency that is pegged to a basket of international currency weighted toward the U.S. dollar but with diversification to reduce volatility. Now, why do fluctuations between these two currencies matter for the stock market? To answer that, we need to understand a key principle: stock markets react not just to corporate earnings, but to investor expectations about economic health, liquidity, and purchasing power. When the U.S. dollar strengthens relative to the Kuwaiti dinar, it can create a ripple effect. For example, Kuwaiti investors holding large portfolios of U.S. assets may see a change in the value of their returns when converted back into dinars. A stronger dollar means their dollar-denominated investments yield more in local currency, often encouraging continued or increased investment in U.S. equities. On the flip side, a weakening dollar can erode those returns and lead to capital rebalancing. Let's look deeper into Kuwait's side of the equation. Because the Kuwaiti dinar is pegged to a currency basket, the Kuwaiti central bank actively manages the exchange rate to maintain stability. When the dinar strengthens excessively against the dollar due to high oil revenues or shifts in the currency basket, the Kuwaiti stock market can face headwinds. Imported goods and services become cheaper, which is positive for consumers, but exporters and companies reliant on foreign sales may see profit margins squeezed. Investors then adjust their expectations, which can lead to short-term volatility or a gradual cooling in certain market sectors. Conversely, if the dinar weakens slightly while oil prices remain high, local exporters may benefit, and the Kuwaiti stock market can gain momentum. It's a delicate balance. Too much volatility undermines confidence, but a controlled depreciation can sometimes spur economic activity and stock market enthusiasm. The U.S. perspective is equally critical. A rising dollar often signals investor confidence in the American economy, but it can also hurt U.S. multinational corporations by making exports more expensive for foreign buyers. When the dollar is strong relative to the Kuwaiti dinar and other Gulf currencies, American oil companies and technology exporters may feel the pinch, which can drag on U.S. equity indices like the S&P 500 or the Dow Jones Industrial Average. On the other hand, a weaker dollar can boost these exporters and lift stock prices, though it might also stoke inflationary pressures. Energy markets tie this all together. Oil is priced globally in U.S. dollars, so movements in the dollar-Kuwaiti dinar exchange rate have a direct impact on Kuwait's revenue. When the dollar strengthens, oil revenue into local currency can decline slightly, even if the nominal price per barrel remains unchanged. This dynamic influences Kuwait's government spending, infrastructure projects, and ultimately the earnings potential of companies listed on the Borsa Kuwait Stock Exchange. If government budgets tighten, corporate profits may be affected, which in turn moves the stock market. Investor psychology is another powerful factor. Currency swings often signal broader economic trends, instant rate changes, geopolitical tensions, or shifts in global trade flows. When traders see the dollar rising sharply against the dinar, they may interpret it as a sign that U.S. interest rates will remain high, attracting capital to U.S. markets and perhaps pulling funds away from emerging or frontier markets like Kuwait. Alternatively, a sudden drop in the dollar might suggest economic slowdown in the U.S., prompting investors to hedge in commodities or stable Gulf equities. To illustrate these relationships, consider historical case studies. During periods of high oil prices, such as the early 2000s or the post-pandemic rebound, Kuwait enjoyed strong fiscal surpluses and a stable dinar. U.S. equity markets often moved in tandem with oil sector profitability, but sharp dollar swings veered by Federal Reserve interest rate decision caused short-term turbulence in both regions. Similarly, during the 2008 financial crisis and again in 2020, aggressive U.S. monetary easing weakened the dollar, prompting shifts in capital flows towards safe haven assets, including certain Middle Eastern markets. Looking ahead, several variables will shape the dollar-dinar dynamic and its influence on stock markets. Key among them are U.S. Federal Reserve policy, global oil demand, Kuwait's ongoing economic diversification efforts, and geopolitical developments in the Gulf region. If the Fed maintains higher interest rates to combat inflation, the dollar may remain strong, potentially pressuring Kuwaiti stocks while attracting Kuwaiti capital to U.S. equities. Conversely, if global oil consumption stays robust and Kuwait successfully expands non-oil sectors, the dinar could maintain or even strengthen its purchasing power, cushioning local markets from external shocks. For investors and traders, the lesson is clear: monitoring the USD KWD exchange rate is not just an exercise in currency speculation. It is a vital indicator of where capital may flow next and how stock markets might react. Whether you are a portfolio manager in New York, a retail investor in Kuwait City, or an analyst in London, understanding this relationship can help you anticipate shifts in market sentiment, adjust hedging strategies, and identify opportunities in both equities and commodities. In closing, the interplay between the U.S. dollar, the Kuwaiti dinar, and global stock markets underscores the interconnectedness of modern finance. Movements in one currency pair reflect not only the economic health of two nations, but also the broader forces of energy markets, monetary policy, and investor psychology. By keeping a close watch on these dynamics and by appreciating the historical context and forward-looking indicators, you can make more informed decisions, whether your goal is long-term investment growth or short-term trading success. Thank you for joining this comprehensive exploration of the dollar-dinar relationship and its powerful impact on stock market performance. Stay informed, stay diversified, and remember that in today's global economy, currency movements are never just numbers on a screen. They are signals of deeper trends that shape opportunities around the world.